Welcome to episode 103 of the Closing Table with Lawyers title. I'm your host, Tamera Gaede, and today's guest is going to talk about, what's going on with rates and the Federal Reserve right after this.
Welcome to the Closing Table with host Tamera Gaede, where we break down how to be successful in real estate and what it's really like to work in the real estate business. This is the Closing Table with Lawyers title.
Welcome back. Again, this is episode number 103. I'm your host, Tamera Gaede. Today's guest is Aaron Bush. He is the mortgage pro, Fairway Home Mortgage. Do you know he's been originating loans for 27 years? And he's been with Fairway since 2014. And Aaron and I have partnered. I brought him in quite a few times to help with understanding what's going on. We're hearing a lot of news, a lot of media news about rates and what's going on with the Fed. And I wanted someone to come in today and sort through the noise and make it so that everybody can understand where we're at right now. So, Aaron, thank you for joining me on the show today.
Of course. Thanks for having me, Tamera. Appreciate it.
Glad to have you. And I've always gotten really positive feedback anytime you've come into a meeting of mine to help everyone understand exactly what's going on and sort through all the noise the media is giving us about what's going on with tariffs and rates and how does this affect us? Does it affect us? You've been a really great educator in that from that standpoint. Thank you.
Thank you. Yeah, absolutely.
So, let's get going. Let's start with, how about you just kind of remind us what this year has done and kind of where we're at right now. And we need to include today's date. I don't even know the date. It's September 23rd. Today is September 23rd, 2025. So talk about, where did we start the year with interest rates and where are we right now?
Yeah, it's such a great question. There is so much noise, Tamera. I mean, I think we just have to really look beyond what the news, everything is saying, and really focus in on the key points, which is rates are down tremendously from the beginning of the year. I mean, if we even go back to October of 2023, rates were over 8%. The beginning of this year, they were 7.25%, and now
I forgot that they were over 8.
Yeah.
Okay, keep going. I'm sorry, I interrupted.
No, it's easy to forget.
23 and 7 at the beginning of the year.
Yep.
Were they over 7 at the beginning of the year?
7.25%, 7.26
okay.
was the peak in January, and now we're down to an average of about 6.35. But the crazy thing is, just 1 week ago, they were 6.1, and now we're 6.3 roughly. So, and a lot has happened in the last week. So we can touch on that, of course. But it's interesting.
And of course, the real estate news says, all of these, I'm telling you, I literally got like maybe 4 different news sources hit my inbox later part of last week. Interest rates are plummeting, is what it said.
Right.
And I'm like, plummeting?
Right.
Are you sure?
Right. Yeah.
Are you sure? So of course I go and bloop, bloop, bloop. Where are interest rates today? And I'm like, yeah, okay. Plummeting. Yeah. So that's part of why I brought you in, right? Because they're not plummeting.
Right.
So help us understand. Okay. So you kind of helped us understand where we are today. Did you need to expand it all on that?
No, that nails it. Just low sixes roughly with, we'll see. Some lenders are going to advertise high 5. Some, will advertise different stuff. Just depends. But average low 6s right now.
Okay. So kind of piggybacking off that, should buyers have a sense of urgency right now to get out and buy a home?
Yeah, I think it's an opportune time. And here's why. We're really beating the rush, kind of beating the news, so to speak. It's kind of like, an iPhone announcement when Apple comes out and says, hey, we got a new phone, and there's going to be some early adopters that go in and get it. But most people wait until later. This is kind of the opportunity right now for people to be able to take advantage of rates coming down 1%. I mean, they have plummeted in that sense. I mean, they've come from 7.25 down to low 6s. So they've come down 1%, which is huge.
That's kind of a plummet, sure.
Yeah. I mean, over the last few months, maybe not as exciting, but I think the buyers should have a sense of urgency, because as this stuff starts making national news, which now everybody's going to be talking about, these Fed cuts, which just happened last week.
But they already are. Yeah.
The Fed has said they're going to cut a couple of more times potentially. I think we'll talk about that later in the show. But as that stuff makes national news, that now everybody's into it, right? They all understand, oh, okay, now I got to go out and buy a house. But those people that can look now, there's still a little bit of a window of opportunity because we're seeing a shift to a buyer's market. So with that shift to a buyer's market, there's opportunity for buyers to come in. And as we get more buyers, that might shift it back to a little bit of a seller's market. So I think that's the sense of urgency that buyers can have right now.
Yeah, and we're hearing news also about sellers retreating from the market.
Yeah.
And we've got our sellers have fatigue right now. They've been on the market too long, and we'll talk about sellers later in the show. But as far as that is concerned, that will reduce inventory, right, and make your choices as a buyer. You have a smaller pool to choose from if sellers retreat from the market. Now, I don't know how many. I haven't run MLS data, so I don't know how many sellers are actually retreating from the market. But, that's another part of the noise from the media that
Right.
we're hearing. But,
Right.
if there is truth to that in our local MLS, then you've got an inventory shrink, right? And so buyers are going to have less of a choice. Now, if rates do end up plummeting, and I've always said, and I would like your feedback on this, if we kiss the fives, we're going to see a kind of a floodgate of activity, right? People are going to refi. That's going to be close enough to what they secured back during COVID. If they need to make a move or have been wanting to make a move, I think that'll kind of give them enough juice to go ahead and do it and be okay with sacrificing their 3.5 or 3 or 2, even 2.5% interest rate. Do you agree or disagree?
I agree. There's been a bunch of studies on this, and the unlock rate has to start with a 5. If it has a 5 handle, people are going to be interested. I mean, the reality is whether it's 4.9 or 5.9, I mean, yes, that can be a difference. But for whatever reason, psychologically, if it starts with a 6, that's not great for people, or a 7.
Sure.
But if it starts with a 5, people are going to be more interested.
Because then we're going to have too many buyers, right? So then we might see multiple offers again. We're going to see prices go up. So, this is the time for a buyer to kind of heed and pay attention to the opportunity. I've struggled with that as an investor myself, meaning money's still a little expensive to make the cash flow numbers work, especially if you're a financed buyer. But if you wait to try to buy a property later, you're going to be paying more, right? So, it is really important to connect with your mortgage advisor, like someone like Aaron. And I recommend, Aaron, that you reach out to him, because, contacting someone like that to really run the numbers for you to see what's going to work and when is going to be really important. But okay, so we've kind of established that our buyers need to go ahead and, if you're looking to buy, right, let's get off the fence. Let's actively look. Now's the time to work on securing that next property or your first property, right? So let's go back to the Fed. Let's talk about how they're making decisions, right? You said yesterday in our conference call, that they were making decisions based on data. So what kind of data are we talking about that affects what the Fed does with rates?
Yeah. It's an incredibly good topic, because Chairman Powell, most of the Fed members, and they're doing a lot of speaking on news shows and all kinds of stuff right now. And what they're pointing to is the unemployment and jobs number. So that's the data. In addition to that, they're also looking at inflation. They've defined inflation as being a little sticky. So in other words, they're not really 100% focused on inflation as the key component to lower the overnight rate, because that's the rate that the Fed controls. It's the rate at which banks borrow overnight. So, but that has an impact on long-term mortgage rates. So the main data points that they're looking at, again, is inflation and employment. But inflation has just somewhat remained elevated. And there's all sorts of reasons, from tariffs to other things. But unemployment has been rising. Job numbers have been weakening. And so that's the one that's the reason the Fed decided that they were going to cut last week. That's the reason, because of the employment data.
Yeah, we've seen those reports coming out, and they were disappointed with the unemployment numbers. Yeah,
exactly. And this is the crazy part. Do you mind if I just dive into the employment numbers?
No, go ahead. Yeah, absolutely.
So the crazy part about the employment situation is every month they release that. When I say they, it's the BLS, the Bureau of Labor and Statistics. They release new job growth and the unemployment rate. And there's always a headline number of new job growth. It might be 100,000 new jobs. It might be 300,000 new jobs. And they release that headline number. And then as the months progress, in the beginning of every year, they release revisions. and they say, hey, you know what? Yes, we said the prior year was X number of jobs, but it was really only this many. So
Right.
in the beginning of 2024, they made, I think it was March or February or March of 24, they came back and said, hey, we overestimated jobs by 800,000, which was huge. I mean, it's almost 50% of the jobs that were created.
That's a lot of jobs.
It's significant. And then they did the same thing just a couple of weeks ago. They announced the revisions through March of this year for the prior 12 months, and it was over 900,000 jobs.
That's
So
incredible.
the
Okay.
crazy, right. So the crazy part is the Fed's making all these immediate decisions based on the immediate data reports. Like, okay, the jobs were X amount this month. So they're making decisions based on that, though that data isn't correct. And this isn't
Okay.
my opinion. This isn't pundits' opinion. This is the government's opinion. The data that we're releasing is actually not correct, which is crazy.
Well, okay. So what do we do? What if the data is wrong? What do we do?
Yeah. So if the data is wrong, that means the Fed is behind the curve. And that's what many Fed members, I shouldn't say many, there's been a handful of Fed members have been saying, like, we need to get ahead of the curve. It's like, I'd equate it to braking when you're driving into a turn. You don't brake when you get to the turn, you brake before the turn, or at a stoplight, right? You slow down before the stoplight. So you start cutting rates before you really need to. So you got to have some predictive models. That's what the Fed is really failing on right now. And look, easy for me to criticize, right? That's not my job. But
No, let's get you in there, Aaron. I'm okay with you joining the Fed. Okay, so we know we've established that how the Fed makes decisions, right? And we've kind of talked through, issues with data being incorrect or overestimating data. Okay,
right.
So if we want to pay attention to what's next, what are some of the key dates that we need to watch for the job report? Okay. And then also walk us through how that affects rates. So let's start with dates and then and the effect part of this.
Yeah. So first and foremost, key times or key dates to watch. First of all, every week there are economic reports that affect mortgage rates. A lot of people don't realize this. I mean, this goes back to why rates are low right now. It's not because the Fed cut. It's because the anticipation that the Fed may cut or have future cuts. So that's why mortgage rates really moved, and they moved in advance of the Fed. First of all, that's a huge misconception, right? So, but all of that happened because of employment reports or inflation reports that are coming out. So the next critical one to watch is October 3rd. That's the next employment report that we're going to get. It'll have an unemployment rate and new job growth. And if unemployment happens to be up, or if new job growth is really slow, you will see mortgage rates plummet or go down a little bit, right? We'll at least see them come down some.
Well, I want to back up before we go forward. Okay, I want to back up a little bit because you said something really interesting. So the mortgage rate cuts were before the Fed made announcements, right? So look, keep in mind what the Fed rate is doesn't necessarily affect the mortgage rate, right? So our mortgage rate cuts were earlier this year, not now when all of this noise is happening, right? So everyone needs to remind themselves when these Fed announcements come out, that isn't what's happening with mortgage rates, okay? So don't post the memes about mortgage rates plummeting anymore.
Well, and the funny thing is the Fed spoils their own party. I mean, they announced this cut and this is going to be great news for borrowers. And then they say, hey, we have potentially 2 more cuts this year. That's the big announcement. Mortgage rates actually started to move down a little bit. This is all same day. Mortgage rates started to move down a little bit. Then when Chairman Powell came out for the conference, he said, hey, we're still going to be data dependent. So we can't guarantee we're going to have 2 cuts. So, and which is understandable, but at the same time, it just sort of spoiled the party. And that's why mortgage rates actually went up. If you look at the chart, mortgage rates went up the day after the Fed cut, which is counterintuitive. It's so counterintuitive. So,
well, and when people ask me if I think rates are going to drop, first of all, I'm not a mortgage lender. I'm not part of the Fed. I'm not anything. I'm a title. I am something. I'm entitled, right? Wrong industry. However, I also tell them I'm not getting excited about anything till it actually happens anymore because we've heard since Q3 2020, was it 22 or 23 that rates were going to drop, plummet drop, right? So
Mhm.
here we are in September of 25, and we haven't seen the plummet. So I don't get excited about it anymore until it happens, Aaron.
Right, right. 2020, they meant 2028 is what they meant.
Yeah, right, right. This tsunami of buyers coming back in the market.
Right, right.
How many times have we heard about the tsunami of buyers that are in this pent-up demand? Well, okay, I'm ready.
Right, right. Well, and what's crazy, look, I don't want 2020 again. I don't want 2021 again.
No, no, no,
I,
no,
I
no.
want
Let's be
I
clear
want
about that. Yeah,
2015,
yeah,
2016, 27.
yeah.
Those were great years for real estate,
Yes,
great years for mortgage, but those were just, and 2010s, those were great. We just want a normal market. That's what we're
sure. No, and look, all of us that have been, I haven't been in the industry 27 years,
after. By the way, I
but
started when I was 10.
yeah,
Yeah.
but I've been in it long enough to know that it always comes back,
Right,
you know?
right.
So everyone just hang on. It's going to get fun again. Okay. So let's kind of go back to, you mentioned the BLS, right? So there's been some shuffling around within the BLS. So do you want to talk about that and how does that affect what we're watching and paying attention to?
Yeah. So the head of the BLS was fired. And if you read up on that, you're going to see different reasons that happened. People will say it's political. Maybe it's because the data is incorrect. Look, I don't think it's an easy job. So the head of the BLS was fired. They, I've heard people say, "Oh, they just got to count the numbers." Well, look, counting that sounds really easy, but when you have to look at an entire multi-trillion-dollar economy and figure out how many jobs there are, what the unemployment rate is, because the way they determine the unemployment rate is they ask people to participate. They literally call people and say, "Do you have a job?" Like that's part of the process. That, right.
Just
That's
got to
insane.
put away.
That is old technology to handle
Yeah,
a current problem, right? So that stuff happens. And so the data itself is really unreliable because of their methodology. So their methodology is just skewed. But that's what we have. That's the methodology that we have. So I think the firing was simply, the reasons behind it are really irrelevant. What I hope happens is that we get some fresh blood in there that says, the old way of doing things aren't working. So we need to come up with new methodologies. We'll see if that happens. That may be a pipe dream, but that's really the point should just be to get accurate numbers. If the numbers are weak, we need to know that. If the numbers are strong, we need to know that. We just can't, the Fed has to make decisions on accuracy. And that's been the challenge.
yeah, and underestimating by like close to a mil
Yeah.
signifies
Yeah.
that that what they're doing is not working.
Correct. Exactly.
But we want to make sure that we keep the conversation coming back to how does this affect our local real estate market and things like that. Now, I have a couple other questions before we kind of bring it back. You said something yesterday that there's some unusual activity with the Fed, and do you want to talk about that? And I think they're divided on some issues, and how does that affect what we're paying attention
Yeah,
to?
100%. So the craziness of the Fed is that when they met in July, so a lot of people don't realize this. They hear about Fed Day when the Fed cuts, but the Fed meets, I think it's 10 times throughout the year. Maybe it's 9, but it's something like, it's a big number. And they met in July. And for the first time in 32 years, two Fed members voted to dissent from the group. In other words, two Fed members voted to cut while the rest, so there's total 16 voting members. The rest didn't. So the rest voted to leave rates the same, but two dissented. That hasn't happened for 32 years. So that's the first point. They like to be unified, right?
Okay.
So this is the first time in 32 years where they haven't been unified. They maybe behind the scenes, they're not 100% unified, but at least when they're going public, they want to present a united front. Well, that didn't happen in July.
It's kind of a stalemate.
Well, just two voted to say, no, we need to cut, and the rest didn't. So yeah. So, that hasn't happened. Fast forward, this time, there was a Fed member that voted to cut 50 basis points while the rest voted, the ones that voted to cut voted for 25 basis points. So that was kind of unique. There was still, I think, one or two members that voted not to cut. So they still have quite a bit of division there. Then another Fed member, meanwhile, all this stuff's going on. There's a Fed member that's being investigated for mortgage fraud.
Yeah.
Now, you can make
and I think we've got a president going after a
Yeah.
few of them, or
Yeah.
at least one.
You can make the argument that that may be politically motivated
Yeah, yeah,
investigation,
yeah,
but we'll leave that for the experts to decide. But the bottom
sure,
line is there's a lot of division, and then Trump and Powell have been butting heads every
right.
time they get together. So it is very unusual what's happening right now.
Yeah, but
Um,
isn't Powell's term up in like March or something? I mean, he's coming to the end of his term anyway, correct?
May of 26.
Oh, May of 26. Okay, well, yeah, it was close, 2
Yeah,
months. Okay,
and
but so we're probably, we could be potentially facing a change when that happens, right? Trump will get his way,
yeah,
get
and
rid of him.
what could happen there? This would be crazy. There's this term, I didn't mention this to you yesterday, but there's this term called shadow Fed president. And you don't,
Okay,
so what I've read a few articles on it, but there's not a lot. But what that means is that President Trump could go ahead and announce his candidate for the next Fed president. And by doing so, now other Fed members will start looking to that new soon to be Fed president, and it will diminish the impact of Powell. Trump hasn't done that yet, which is kind of surprising, honestly. When I read
yeah,
that article, I'm like,
and
that sounds like
yeah,
something that would happen, But
mhm.
nonetheless, it hasn't happened yet. But it could. It could happen, and that could change the dynamic of the Fed, throwing even more division, or maybe that would create the opposite. Maybe it would create a little bit more unity because some Fed members would agree with whoever this new Fed president is. So it's tricky, but stuff is happening that we haven't seen in decades, and at the same time, we haven't had this kind of economy in a while. So high inflation, sticky inflation that doesn't want to come down. So
A
we're in
lot of
unique,
criticism. Yeah.
yeah, we're in unique times.
Well, how does all of this shape what's going to happen next? So take what, how does this affect what we're going to be looking for next?
Yeah. So the Fed announced, at the last press conference that they anticipate two more cuts. They
Two more,
kind of
yep, we did that.
argued
Before
against
the end of the
themselves.
year, right?
So sorry, I didn't catch that.
Is it before it's before the end of the year,
Yeah,
right?
before the end of the
Yeah.
year. Sorry. Yeah. So they'll meet again in October and
Okay.
December.
Yep.
So assuming they cut both of those times, and the big assumption is that they also seem like they're happy about it. If they're happy about it and they seem like it's necessary, we could see mortgage rates decrease even more. We could see that 5 handle. And that would be pretty critical for the market.
Merry Christmas.
Yeah.
And Happy
Yeah.
New Year. Yeah. Everybody get your vacation, your Christmas vacation. Sure. We're busy.
Yep. Yep. Yeah. It'll
Well,
be
from your lips
busy
to
night.
God's ears, Aaron. I mean, I keep saying that from your lips to God's ears for sure. Now, do the tariffs have any effect on what is going on with interest rates? Do we need to be paying attention to what the activity is with and the traffic is with the tariffs? I mean, look, when that all first announced that Trump was going to be putting in tariffs in place for imports, higher tariffs, excuse me. We had a lot of media noise about that too, and how that was going to affect the real estate market. I don't know that we've seen much, yet. I mean, they do talk about the cost of consumer goods and how retailers are taking the hit. I'm not sure how much that's translated into our local real estate market yet, but do we need to be paying attention to what's going on with tariffs as it affects interest rates?
Yeah. When the Fed met last week, they basically said, hey, we're not seeing an incredible impact of tariffs. And if there is, we think it's temporary. So in other words,
Yeah.
inflation is like prices keep climbing, right? So tariffs are more, the way they define that is more of a one-time impact. So it's not going to be a continuous thing. So they don't see that as a big inflation driver. But
Okay.
in some of the inflation reports, prices have gone up. I mean, that's just a reality. So I think for many people, they are feeling the pinch of tariffs, whether or not we want to argue that's a good thing for our country or not. That's a whole nother topic. But I don't think the Fed's paying as much attention to that as they had said previously. So in prior meetings, they're like, we don't know the impact of tariffs. And in this last meeting, they're like, we don't think it's that much. And if it is, it's transitory. It's not going to last very long.
Yeah, and whenever something new like this comes on into the forefront of the conversation, everybody kind of, oh my God, what's it going to do? And then you find out later it's not really doing much.
Right. Yeah. Except eggs, right? For whatever reason, eggs.
Right.
Because they're
I don't even know what is the price of a dozen eggs right now. I don't even know.
too expensive. We gotta get our own chickens. That's what we got to do.
Yeah, get your own okay, I don't want chickens, but I do like the farm fresh eggs. And so I like knowing people that have chickens.
Yes.
How about that?
Yes. That's
Okay, so we've talked a lot about what's going on with the Fed, what's going on with BLS, what's going on with tariffs, how that affects interest rates. But let's talk about what we should be paying attention to locally, right? So let's bring that back to how that conversation affects what we're doing day to day here. So what should we be paying attention to? We know we should be paying attention to some of the job reports we talked about when those timelines are coming out. Then we also told the audience when the Fed was going to meet. Okay. So what's next? I mean, is there anything else that we need to be paying attention to here locally?
I mean, those are the big things in terms of,
Okay.
yeah, in terms of what's going to affect our buyers and sellers. Um, it, in my opinion, we should be speaking more specifically instead of broadly. And what I mean by that is we need to show people, not tell people, right? So it's really easy for us to be on here or when we're talking to clients and realtors that, hey, rates have dropped, rates are lower. But if people don't really understand the impact of that, then it just goes by them, right? So in other words, when we say rates have dropped 1% since the beginning of the year, I think we need to be putting that in context of dollars. So on a $400,000 house, that's saving people an average of $188 a month. That's important to understand. That's almost $200 a month, and higher price points are even higher. We can see $200 to $300 a month very easily in our market. That's significant, especially when you do it over time. So I think that's the kind of stuff that really matters and resonates for people, is understanding the impact. The other impact is buying power, right? So one impact is affordability. Yes, we can afford more. Or my
Yeah.
payments are cheaper. But it also means that person that was maybe struggling to find the house they wanted at 370 or 380, now they can buy 420. Or that person that was struggling at 500, maybe they can buy 550 now. That is powerful for people. That's, I think, if we can show people the impact, and that's how we affect our buyers, our local people, is to show them, not tell them.
Well, and you have, I've seen it before, a nifty little tool that you have in your toolbox to really show buyers the impact of a rate reduction or bringing more money to close, how it affects their actual bring to close, their mortgage payment, and then the amortization schedule, the life of the loan, right?
Right.
We have a similar tool that can do what you're talking about. I think yours was able to dive deeper into the breakdown of the mortgage,
Right.
The financing side of it, whereas ours stays a little bit more broader. But our access to Lawyers Agent One that we provide to realtors, plus your program, do you tell the name, or do you prefer people to reach out to you to get that, to see what that would look like with their specific buyer?
Yeah, the program we use, I'll tell the name. I think if there are mortgage people watching this, you should be using this program. Like, I'm giving you my cheat code here.
Yeah, I didn't mean to
No.
expose
I love sharing it. It's Mortgage Coach. Mortgage
Okay.
Coach. And if you're a realtor, you should be asking your lender, do you use Mortgage Coach? Because
Yeah.
what it allows us to do is put side-by-side options. And this is really, I think that it's educating people. It's helping them understand, like, a realtor will have a buyer that says, my max is 390 or my max is 650. But in reality, as that agent knows, if I could just get them to 700, I could get them everything they want.
Right.
That's the power of that Mortgage Coach, because it puts those options side by side and people see, oh, it's only $150 a month, or it's only 250, whatever that number is, that difference. A, they got to qualify for it, right? First and foremost. But B, if they do, it just might be a psychological barrier. So that's what I love about Mortgage Coach, and it breaks down the amortization and all this stuff. It's fantastic.
Yeah, it's very a lot. It lays everything out very nicely, and I think it's really important to show people what it to see it on a screen or see it on paper in front of you. That makes a bigger impact, at least to me, than it does just hearing the number, right? When you actually get to see how it applies over your monthly payment and then the life of your loan. And people always, in my opinion, need to pay attention to their monthly payment. Okay. Mm-hmm. Instead of saying I can afford a $700,000 house, say I can afford a $3,500 a month mortgage payment, and that's all in, right? So I think that's a much better way to approach it. And then back in the numbers from there, because really what you care about is what's coming out of your bank account every month, right? To pay your mortgage.
Yeah.
But that's my own
I mean,
Anyway.
I met with a client right before this using Mortgage Coach. By the way, they should write me a check. I'm just totally promoting your product here. But
Yeah,
I met with a customer this morning and they're like, I got to put $100,000 down to get to my payment. And we run the numbers. I'm like, no, to get to your payment goal, you actually only need to put 50. Like,
oh, perfect. That's
and
what a relief.
but yeah, exactly. But then showing them, here's what it would be with 100K down. Here's what it'd be with 50K down. Not just loading their inbox with estimates,
Sure.
but actually showing them side by side, walking them through it. It's powerful.
Anyway, I think that would help with, our plummeting of interest rates. How's that going to affect a buyer? When's a good time to refi? All those questions that you're going to get now that we're starting to see a little bit of a drop in the interest rates. So let's talk about our sellers for just a second, because they've been experiencing longer days on market, as we know. How does all of this that we've been talking about today help them?
Yeah. So it's the light at the end of the tunnel. I don't want to get too dramatic with it, but I think it's what people have really been waiting on. They need sellers, like you said, days on market are longer. This has the potential to bring more buyers out there and create. Look, we don't want 2020 and 21 when people were. Maybe some sellers do, but for a healthy real estate market, we need an equilibrium, right?
Yeah, we want it to be healthy.
Yeah,
I agree.
yeah. So, but right now it's a little unequal in the sense that we have a few more sellers than we do buyers. That's a buyer's market. So sellers want a few more buyers, and that's what these lower rates are going to potentially do, is bring more people out there. I wish it was timing more with the spring market. Like, that would be incredible if that was what's happening, but it's happening now. And I think there is, look, the data says that there's pent up demand. So if we believe that, if we believe those numbers are right, then we should see a few more buyers, and it should be some needed relief for sellers. But I think sellers still have to do their part when they got to listen to their real estate agent, right? If their real estate agent says, hey, the market is 500,000 for your house, you can't ask 550 or 600. Yeah. You got to be realistic. This ain't 21 anymore. So I think they have to be realistic, but they also can use some tools. And I don't want this to be shameless, like self-promotion here, but lots of lenders have this. We have tools where we can lock a rate in advance for a seller, not for a buyer, for a seller, and you can advertise that lower rate. Now, the best way to do this is to spend some money. So work with the real estate agent, work with the realtor to price this out. And let's say we want to spend 3% to buy down the rate. Now you're offering a rate in the fives, or maybe you're doing a temporary buy down where we buy it down to 3.9, 4.9 for the first 2 years. And then it locks in at 5.9, still a fixed rate. Those are the kind of things that can move the needle and make your house stand out as a seller. So that's the kind of stuff that I think sellers can look forward to. Lower rates, of course, are going to help, but being a little bit strategic with rates coming down. We don't want to advertise something with a 6. We want to advertise something with a 5. That's going to make the house.
Because new construction's advertising things with a 4.
Yeah, exactly. And sellers
we're surrounded by new construction here.
Yeah, resale sellers can do the same thing. They just got to spend the money. That's how builders do it. There's no magic there. They just build it into the price. It's the same thing for sellers.
So I actually wanted to ask you, did conventional limits rise? And if they did, what did they rise from, what to what?
Yeah, so that's kind of a cool thing that I love about Fairway. So conventional loan limits rise at the beginning of every year. So every year, they'll say loan limits have risen to this, and FHA limits do this as well. We announce it early, what we anticipate. I don't know what predictive model we use, but there's some predictive model, and conventional loan limits are going to rise to around 830 from 806. So 806,000 to 830,000. That doesn't sound like a huge move, but it really is a big move. Especially because what it does is that anything above right now, 806, anything above that is considered a jumbo loan, which are harder to qualify for and can be higher interest rates. So if we can move that needle up a little bit, it helps buyers, it helps sellers too. And so we know that loan limit's going to be moved up. It's going up to 830, and we are doing that now. So you don't have to wait until January. We do that now.
Okay, so this is a Fairway.
Correct. Yeah.
Okay, not abroad. Okay, I'm misunderstood. I'm glad that we clarified.
Yeah.
So thank you for that.
Yeah, and
Okay,
I don't necessarily want to say that other lenders don't do that. I don't want to speak for every lender out there, but not
sure.
every lender does it. So I love the fact that we do that. We have to hold the loan. We can't sell that loan until
Right,
January.
right,
So
right.
if we're closing now, we got to hold it for a couple of months. So it costs us money, but it's a good way that we can push those new loan limits and help buyers get higher loan amounts now if they need it. Obviously, if they don't need it, it doesn't matter. But yeah, so that's a pretty cool thing.
Okay, and then before we wrap it up, because we are getting to the end of the show, before we wrap it up, is there any advice you'd like to leave my realtor audience with before we tap out for the day?
Yeah, I think just, understanding what's happening with the market. I hear so many realtors go, I'm going to stay in my lane. And I think that's great. I think I should stay in my lane. I should be pricing out, a
We
seller's
should
house,
all stay in our lane,
right?
Aaron.
But I do think it's important to understand some of the stuff that we've talked about at a very basic level and just go, at least to be able to say, hey, I'm hearing this stuff in the news. Is that accurate? I can't tell you how many realtors reached out to me the day after Fed cuts and said, did we get lower mortgage rates?
Right.
And
Yep.
so I think if we can understand that at a professional level for our business, we can help consumers because then we can drive urgency because that's what we have to do. Knowing that mortgage rates really move in advance of the Fed, we don't need to wait until Fed day to take action. We need to be understanding that, having that sense of urgency before things move.
Yeah, there's such a misconception about that
Right.
out in the marketplace
Right.
for sure. So I think continuing your education is always important, right? We can
Yes.
all learn something.
Yes,
So,
exactly.
all right, Aaron. Well, thank you so much for
Oh,
being my guest today.
absolutely.
I
Thank you.
enjoyed our conversation and I think it was very educational for my audience as well. So I'm excited to get this one out so everyone can watch and see what we talked about
Thank
today.
you for doing this stuff and bringing people in to help your folks. So I'm grateful
Thanks.
to be here. So
Well, thank you again so much. And again, that's a wrap on episode number 103. Again, I'm your host, Tamera Gaede. If you like my content, you're really going to love my escrow team. So give me an opportunity to work with you on your title needs and make it a great day.